Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Asian stocks sparing gains as tech losses momentum, with Korea reversing sharply. Chip signals turn mixed amid shifting AI confidence. Oil steadies near $72 as Hormuz flows recover, and OPEC Plus signals more supply. Fears of a glut rising as more oil hits the market. Zuma Wealth founder and CIO Terri Spath will be joining us to talk market resilience, valuations, and where she sees risks building in the second half. Plus, Indian bonds see foreign inflows rush back in. Neuberger Berman's Prashant Singh will break down the carry trade, currency risks, and why global investors are leaning in. Our top story today, oil prices fluctuating even as smoother sailing is observed along the Strait of Hormuz. 6 oil and gas freighters were seen navigating a U.S. protected corridor on Sunday that cleaves close to Oman's coast. This comes just days after some vessels performed unexplained U-turns and detours. But while confidence appears to be returning to the strait, fresh security concerns have emerged elsewhere. In the Red Sea, a cargo vessel reported coming under attack on Sunday, underscoring persistent risks facing maritime trade in the region. For more, let's bring in Bloomberg oil trading reporter Yongchan Chen. Yongchan, I mean, it does seem like a start and stop, but when you take a look at oil prices at $72 a barrel, it shows almost like risks have eased in a big way.
Yeah, indeed, oil prices have come off, quite a lot. They've lost almost all of their wartime gains. It very much speaks to the fact that the market is, certainly in a lot better of a situation than it was earlier in the war. I think, earlier we were saying it's as if like the stopgaps in a sense are working a bit too well. We are by no means, near the end of the conflict. It's all, start-stop negotiations. Producers are ramping up, but they're nowhere near producing at levels before the war. But for now, the big swing factor that kind of that had changed during the war, Chinese buying, that's still absent. They're not, filling up the stockpiles in any way, shape or form that they were before the war. So you have the reduced demand and yet supply coming online in a big way. Yes, flows in the Hormuz are still not smooth, but the stuff that has been able to get out, plus the pipeline flows to Yanbu and other Fujairah places outside the Persian Gulf, all of those supply has been able to meet the demand for now, which is why, for now it looks like it's equalizing a little bit and prices come off.
But the thing is, there are risks, right? And it's not just risks in the Strait of Hormuz, but now with the Red Sea as well, which was, touted as the alternative route. Talk to us about the risks that still remain lingering for all these vessels.
Yeah, so as you say, lots of risks still remaining around in the Red Sea and all these places. So for now, what the oil market is pricing in is the return of supply. Saudi Arabia, the UAE, other suppliers in the US, it's all coming online. So for sure, the Middle East, there is still a lot of risk there. Red Sea risks, may pose a challenge to Saudi flows and whatever. It is true, however, that we do see much more flows from like the US, from the West Africa. There are offers from alternative sources which are still coming in, and that's still propping up supply and pushing down prices. So yes, Middle East risk is still there, but let's not forget it's a global market we're talking about, and so we have a lot more supply that's just coming in from everywhere, and that's kind of pressuring prices.
How did we go from a shortage to now people talking about a glut? OPEC Plus, of course, ramping up its production. How much of a glut are we talking about? And, where would prices be from here then?
I think it's important to remember that even before the war, in the early months of the year, Jan, Feb, the conversation that dominated was in fact a glut, oversupply. Some of that had helped as we went into the Iran war. Now the war concerns are beginning to fade. So therefore, discussions of a glut, those have returned as demand simply eases. The big factor, of course, is China. China simply has lower demand. I think it's something like a 5 million barrel a day of crude that they're no longer importing. So that's a big loss to demand. So even if we have lost supply, like that's the balances, they simply look really quite favorable.
Yong Chang, thank you. Bloomberg oil trading reporter Yong Chang Chin there for us. Let's do a check-in on how markets are faring with Avril Hong. Avril, what are we looking today?
Yeah, I mean, with oil prices at these levels, all things considered, they remain in check. So overall, a supportive backdrop for Asia stocks. Indeed, today you saw more of that Friday rebound in line with US stock futures. But even that is pairing, which to me speaks to the sense of how investors' lingering concerns of whether this AI rally has gone too far and that these AI players are under increasing pressure to show that all that spending is translating into profit. So today, even the South Korean memory makers, they are down in trade, even the likes of SK Hynix, which of course on Friday you'll see that kickoff of the US ADRs, but also the big one, right? Samsung Electronics, which reports earnings tomorrow through the board. And this is a stock, by the way, that has run up 150% so far this year. So the pressure is on for that delivery. You look at how preliminary operating profit is expected to come in at $55.5 billion. This would be an 18-fold jump on year, and all coming at the time where it's been very extraordinary that these memory makers have such pricing power over US tech giants. And you also have some reporting that suggests that the DRAM price hikes for the third quarter from Samsung could come in on an average of 20%. Now flip the board, this dominance and pricing power for the memory makers is what has helped to propel global chip stocks. Of course, in the second quarter, the best quarter on record, but you did see in June a bit of those cracks and doubts starting to show whether it's on competition or overcapacity. And I think our colleagues at Bloomberg Intelligence put it really well in that maybe you see earnings revisions momentum slowing. So it's absolutely critical for that second win to come from earnings. Has?
Avril, thank you. Let's get market insights from Terri Spath, founder and CIO of Zuma Wealth. Terri, good to have you with us. It does seem like the chip rally is hitting some kind of resistance, but I guess the rally is intact.
Yes, and I agree with the insights that you were just highlighting about how important earnings are going to be to the back half of the year. First, thank you for having me on. It's always great to be on here, especially right here at the midpoint of the year. And when we look back at that first half of 2026, for U.S. stocks, as well as globally, the news was that the ability to shrug off the news. You know, the bull market has been remarkably resilient despite that wall of worries. If there's something that we really learned in 2025 that's carried into 2026, it's that many investors simply underestimate at times the market's ability to absorb some of the bad news that creates opportunities. So if we're talking about tariffs, if we're talking about geopolitical conflicts, if we're talking about higher oil rates or about Federal Reserve policy that all create sell-offs, the underlying trend has remained constructive. And I think the reason for that, and I believe the reason for that is exactly what you were just talking about, is that the strength of earnings that we've seen. And it's going to be really important as we go into the back half of 2026. That key takeaway for us is that can we withstand bad news if we can continue to have good earnings going forward for the next couple of quarters.
So earnings durability, Terri, I'm just wondering what your assumptions are. And given that we're seeing, rates higher for longer, how might that play out?
Yeah, I think that higher for longer rate environment was something to get comfortable with at the start of this year. Markets don't really necessarily need falling rates in order to continue to go up, but they do need stable expectations. And I do think that the market has adjusted now to an expectation that interest rates are just going to be higher for longer, longer than we expected at the start of the year, and just longer. They're staying high. But what we've seen, what history has shown us, is that stocks can perform well with higher interest rates, provided that economic growth remains positive, that inflation is contained, that corporate profits can continue to grow. And so at this point, the market really has to earn its returns. With rates as high as they have stayed more recently, and I don't mean like really high, I think they're actually pretty historically pretty average, but they're higher than people expected. It's harder for valuations to expand from here. And that means that the future gains will probably, they need to come from earnings growth. So the question for us right now is whether interest rates have become restrictive enough that they'll materially slow profits. And we don't think that we've seen that. And that's why we think that the second half, again, is going to be driven by earnings growth, despite the fact that we are seeing interest rates that are a little bit higher than we expected even 3 months ago.
We keep hearing that you have to continue investing in AI, but look for scarcity in AI. By that we mean the grids, the chips, things which are scarce in the AI ecosystem. How are you looking at this space?
Yeah, obviously AI has been a great story. It's been a really interesting story. But what we think is a real positive is that we're seeing breadth away from the AI story. That sector participation is really improving. The AI story was just a few names. And that I did not like at the end of 2025, the kind of the Mag 7 that was really driving a lot of the market returns. We've actually seen a reversal of that. When we look at the first 6 months of 2026, the biggest names have actually lagged the rest of the market. And so I think that this AI story, benefiting just a few names, has really broadened out. And that's a very healthy adjustment that we've seen in the market, that bigger breadth. So again, the rally is not driven exclusively right now by a handful of just mega cap tech names. We're seeing broader participation. So we still believe in the AI trade. We still think that that's really going to drive earnings growth. But we also think that there's plenty of ways to make money in markets right now, besides just holding a couple few really go-go hot names that have got AI attached to them. So we're looking at that breadth as opportunity, as well as a healthy sign for the market, and a sign for positive things going forward for investors.
So outside of AI, outside of tech, where do you see opportunities? Where do you see value? Healthcare perhaps is a space we should all be looking at. Yeah, I mean, I think that, one of the things we haven't quite touched on yet is valuations. And I think valuations do deserve some attention because the forward PE on the S&P 500 it's above its historical average. It's not anywhere near some of the extremes that we've seen in the past. But, there's been some pockets of exuberance. And so what we're looking for is where we can see, again, that broader sector participation. And where we're seeing that is where valuations are a little bit more reasonable and not quite as extreme. So financials, for example, are really benefiting from economic resilience. Utilities are still paying nice dividends, and that growth is coming from power demand from a lot of the AI data centers. So there's some, other sectors that we think are also very interesting right now, where there's additional opportunities and not just, just the tech sector or just a few names in the tech sector. Financials, utilities, as you mentioned, healthcare is another strong, relatively inexpensive sector. So I think there's a lot of places where people can put money right now and do well towards the back half of this year. If you're looking at valuations, Terri, would you be looking at emerging markets, small, mid caps? I mean, they were sold off. Valuations look pretty attractive.
They do. And it's interesting what you say about emerging markets, because that's really been I think an area that got hit so hard with these higher oil prices that we've seen as a result of the conflict in the Middle East. And as you were just talking about in the prior segment, with oil prices sort of coming down a little bit, what does that mean? What is that tailwind? It produces a tailwind really across the board, because higher oil prices affect every country, every industry. There's really very, very few places to hide when oil prices are so high. So when we look at outside of the United States, that's the kind of the drifting down of oil prices we think can stand to benefit in the emerging markets countries, just because of that reversal. But I do think that takes time. So while the valuations are better, than they have been in years past. While the oil prices are coming down to some extent, we still think that there can be a lag between knowing those fundamental reasons for looking at emerging markets right now and actually putting money to work. So we'd rather miss kind of the first 10% up, for example, in some of these emerging market countries, and just wait to see where we have the bottom kind of come out when oil prices steady before we're really putting too much work in most of the emerging markets that are out there right now, despite the fact that valuations are cheaper than they have been even a year ago.
And even as you see some potential in emerging markets, you're negative China. Why is that?
Yeah, I'm glad you brought that up. I mean, you know, we have been negative on China now for a long time. The opportunity just isn't there. And there's a number of reasons. It's beyond just sort of the oil problem. We still don't see evidence that earnings and confidence are turning the corner for Chinese companies. The valuation discount is the only compelling plus factor, but that's not enough for us. The biggest risk isn't just economics when it comes to China. It's policy, it's geopolitics, it's trade tensions, it's uncertainty around regulations. All of those things continue to justify a valuation discount relative to other major markets. So for us, the debate on China has really shifted from where it was several years ago with how fast can it grow to how investable is China. And I think that's a really important distinction. And, you know, so we're looking for three things that would change our thesis on that. It would have to be stronger domestic consumption, stabilization in the property sector, and evidence that government stimulus in China is translating into sustainable earnings growth. We're not seeing those things yet with enough conviction. So in the meantime, again, we'd rather miss a little bit of the upturn if that's the risk there. Because investing in China, it's really about the probabilities. It's not about perfection. But again, we still think that there's just way too much in the negative column right now to warrant putting money to work in China. So we don't have any exposure. We haven't now for well over a year on China.
And Terri, within Asia, you're constructive Japan. How are you assessing the weakness in the currency? Might that be shaping, you know, how you view the potential in the market?
Yeah, yes. Japan it's like the flip. That is definitely one of the more compelling investment stories that we've been constructive on for a while. And the renaissance is real in Japan. And I think a lot of people buy into that now. These years of government, corporate governance reforms have really helped. Rising share buybacks have really helped. Greater focus on return on equity. All this have fundamentally changed the investment case. And that end of deflation is just a structural positive. So we continue to believe that Japan really offers some exposure to some different growth opportunities than we have here in the US. You know, speculation is growing on exactly the question you just raised about whether Japanese authorities may be intervening to support the currency going forward. It's getting less predictable. So keeping the markets guessing can sometimes discourage speculative bets against the currency. So we're watching, you know, the biggest risk really, to say it a different way, that we're watching in Japan is the sharper than expected appreciation of the yen. That could pressure exporters. That could lead to faster monetary tightening. But on balance, we feel really great about the structural reforms. We think that's more important than the cyclical headwinds. If you look at Japan as a percentage of the global stock market, it's 5%. If you don't have at least 5% in Japan, you're underweight that country, and we really think you're missing out on a long-term structural improvement that's going on in that country. So we continue to really like the opportunity for investors with exposure to Japan.
Terri, before we let you go, your top call for the rest of 2026.
Well, you know, I guess I would just highlight that a lot of market watchers are asking whether this higher interest rate environment will end the bull market. And we would just remind everyone, your viewers, investors, that earnings growth is what to watch in the back half. So if if higher rates are going to hurt earnings, that would be a problem. We don't see that. If higher inflation is going to hurt earnings, that would be a problem. But we don't think that that's the issue. We think that, earnings growth will continue. It's broadening out in the market. We're looking for strength in the back half.
Right.
And we think this bull market can continue to run.
Always great perspective. Terri Spath, founder and CIO of Zuma Wealth. Thank you. Now, still ahead on Inside, Narendra Modi heads to Indonesia, Australia, and New Zealand this week for talks on defense, trade, and investment. We have a preview next. Keep it here with us. This is Bloomberg. Indian Prime Minister Narendra Modi is set for a three-nation Indo-Pacific tour with stops in Indonesia, New Zealand, and Australia. The trip comes as India seeks closer ties amid questions of a U.S. engagement and China's growing influence. For more, let's bring in Swati Pandey, who leads our South Asia economics and government coverage. Swati, good to have you with us. I mean, this is a reflection of, I guess, the shifting alliances for a lot of Asian countries.
That's right, Has. We have seen a little bit of that middle power powwow happening in recent months. I would say there's a lot of uncertainty around where U.S. stands in terms of providing economic or defense security to Asia. And at the same time, China's assertiveness is a concern for a lot of countries in the region as well. So this trip by Narendra Modi would kind of see these Indo-Pacific countries coming together, discussing defense, discussing economic ties, and that relationship, how that can be bolstered further.
I'm just wondering what's on the agenda, what's really key. Are we looking at specific agreements, for instance?
There will definitely be a lot of discussion around defense and how the countries can come together or support each other or provide defense equipment or support. Although we are not expecting an announcement per se, because traditionally, at least from India's side, defense announcements are not made during PM visits. However, we are hearing that there could be something around critical minerals or uranium. So there could be some agreements or announcement made there.
Swati, before we let you go, it is also about balancing relationships with the U.S. How might that play out for India?
Yes, it is a difficult balancing act because India is talking to the U.S. in advanced negotiations for a trade deal. This has been going on since pretty much the beginning of the year. They have said that they are very close. 90%, 99% of the deal is done, and there's kind of like that final niggling issue between the two countries. So you do want the U.S. to be on your side. You do want that trade deal to happen. You do not want to anger Donald Trump. So that is definitely there, but you also want to make sure that you have strong relationship with your neighbors and countries in the Indo-Pacific. So it is definitely a tightrope walk for Narendra Modi.
Swati Pandey leads our South Asia economics and government coverage there. Thank you. Coming up, Indian bonds attract a record monthly inflow as investors get a tax break. Prashant Singh of Neuberger joins us to talk about the missing pieces of market access for global money managers. This is Bloomberg. Welcome back. You're watching Inside. Amid lingering concerns on the global AI rally, Indian markets are standing out. Avril Hong is back with us for more. What a turnaround.
Yeah, you're seeing, right? I mean, Indian markets have lost out in a big way amid the global AI rally and as those oil prices spiked. But now with these concerns about how sustainable the AI rally is, you're seeing investors taking another look at Indian markets, and there are signs that they are slowly making a comeback. You look at the Nifty 50 for the month of June, for example, it has has outpaced the MSCI EM by the most since the month of November. And if you think about as well, the foreign outflows, that had slowed to a pace that we haven't seen, the smallest in 4 months. Now, flip the board. Also helpful when you look at Indian markets overall is how volatility has been coming down the past couple of months, to the extent that look at how it compares and stacks up versus the Kospi's vol, right? Above 80, that really doesn't look sustainable. Now flip the board again, because that isn't the only Indian asset that seems to be making a comeback. You look at how after months of weakness, Indian bonds also seem to be making that recovery of sorts. And of course, we did see a surge in foreign inflows in the month of June. And then think about as well, partly this was helped along by the government scrapping the taxes for foreign investors, but also the idea that the RBI seems more resistant to hikes compared to some others in the regions, including the policymakers in Indonesia and the Philippines. But we have some words of caution as well from analysts that the momentum might not be sustained in terms of inflows if we see that tightening, whether it's in global financial conditions or in U.S. rates.
Sustainable or not, April, we'll find out. India's bonds attracted a record monthly inflow in June after the government scrapped taxes on foreign investors. As April said, overseas funds bought $4.4 billion of debt under the fully accessible route last month, almost double the previous monthly record. Let's get more with Prashant Singh, Managing Director and Senior Emerging Markets Portfolio Manager at Neuberger. Good to have you with us, Prashant. I mean, comeback story for India, yes or no?
Absolutely. So the case for Indian bonds has it's an inflection point, honestly. I think it's always been a currency story. From a yield perspective, Indian bonds always have been standing out in a region which has been starved for yields, honestly. And now what the RBI measures have done effectively is have made the risk around the INR more two-sided. It has given investors a bit more incentive to hold Indian bonds unhedged. And once you take out the hedging costs out of the picture, Indian bonds absolutely become a standout asset class in our part of the world.
If you talk about it being a currency story, then you have to imagine there is a case when we might see the currency slump the way it did recently. What's the risk of that, and what might that do to investor appetite then?
So I think what can be fairly said is that over the next 6 to 12 month kind of horizon, the tail risks surrounding the currency have been taken out. So the currency at around 95 to the dollar is already screening cheap on most metrics. And all we need really for a strong case for bonds to be made is that the tail risks of the currencies are taken out, the risks become more two-sided, and increase the attractiveness of being willing to take on the currency risk at these levels. And I think to the extent those conditions are fulfilled, I think bond investors will not be overly worried about in the near-term horizon for a sudden spike in dollar INR.
How do you compare Indian bonds versus the likes of Indonesia and the Philippines? I mean, it is a standout. It is in a league of its own, correct?
From a macro standpoint, absolutely. I think the fundamentals of India are clearly a league above a lot of the regional peers. If you look at the inflation story, structurally inflation has been on a very steady footing. It's been coming off. The earlier episodes of spikes due to food prices, etc., they are a thing of the past. If you look at the fiscal consolidation, debt metrics, all of those really put India in a good place right now. The question around macro has never really been there over the last, I would say, 7 to 8 years. It has always been either the currency outlook or the access issue. And I think these measures address both those points, the currency outlook as well as the access issue. And I think that, again, that makes the case for Indian bonds very strong right now.
Fiscal concerns, do they pose a risk? We know that the recent surge in oil prices did put a question mark on Indian finances. Might that be a risk?
Well, with oil prices already coming off, I think some of that risk has been taken out.
And there's no clarity how this might play out.
You're right. So we can't say for certain that we are not going back to a more stressed scenario. But at this point of time, I think the balance of risk does point that we have probably seen the worst of it. If it goes back, we of course have to go back and reassess. But at this point of time, given that India has always been maintaining a healthy buffer versus where global prices are and versus where retail prices in India are, I think that have already held the government finances in a good good shape. So, to my mind, to the extent that we remain there or thereabouts in oil prices, even below 80, that should not be a concern. If we again go back to an average level of 100 for the year, I think that's when we have to reassess this question.
Right, so foreign funds are back for good. They're not just chasing yields. You're confident that they will stay?
Again, I would reiterate, India is one of the few right answers in the region when global investors like us were looking for carry in this environment. And one of the very few good avenues that are available in the region is India.
We saw the massive reversal for Indian equities within the blink of an eye. It was the darling, and then it became a laggard in a huge way because it was seen as a non-AI play. So sentiment can shift very quickly.
It can, but again, the drivers for the reversal in Indian equities versus the drivers for reversal in Indian bonds are very different, really. And as I said, over the next 6 to 12 months, we see very low chance of the sentiment on the bonds reversing. We know there are some headwinds in the offing. We have El Nino, which might be coming up, that might have an impact on the food prices. But we have seen in the earlier episodes of El Nino as well that India now is in much better shape to handle those reversals versus what it was maybe 15 years back. So again, I would be, at this point of time, I do think that Indian bonds are at an inflection point. We do think that they continue to offer a very balanced risk-reward metric here. And I think for now, I do see very little chance of a reversal from a foreign sentiment perspective.
Where's the sweet spot for Indian bonds? 10 years?
So I would actually be willing to go out a little bit more. I think the curve does seem reasonably steep at this point of time. The long end of the curve, 20 years, 30 years, I think they are underinvested by foreign investors. They have only recently been made eligible as FAR securities again. So given the roll down that you're getting, given that there is an underinvestment in that part of the curve, and given that we are relatively sanguine on the broader growth inflation metric for India, I think the long end looks pretty attractive right now.
And how have you been positioning? What are your latest purchases?
So yeah, in line with our thoughts, we have been adding to the long end of the curve. We do think that as euro clearability probably comes back on the horizon, where potential of index inclusion in the Barclays Global, in the Bloomberg Global Ag comes about, I think that part of the curve will start getting a lot more traction. And we think that from a relative perspective, that we can see some outperformance from that segment.
You talked about a time frame of 6 to 12 months. Beyond that, what are some of the considerations?
Again, you will have to go back, reassess whether the fiscal consolidation continues apace, if the targets that have been set for debt to GDP, they are moving in the right direction. The global conditions, what's happening to core yields, I think that will have a meaningful impact on what's happening to a lot of local curves, including India's. So some of those structural questions will have to be reassessed. What's happening to global energy prices if some of the recent positives are reversed? Again, those things become probably questions to be pondered at that point of time.
You mentioned euro clearability. I'm wondering if that is the missing link for Indian bonds right now, and is that a game changer?
I do believe it is. So from a liquidity and a trading cost perspective, India already compares with the best markets in the world. So in the EM space, by far the most efficient, one of the most efficient markets. The question has always been of accessibility. And in spite of the improvement that we have seen in the recent past, India remains one of the most operationally onerous markets to invest in. In that sense, euro clearability an absolute game changer if that happens. So again, we are still in an aspirational space over there. From the last time when we had our discussions with Euroclear, it did appear that the tax consideration was the biggest hurdle. Now that has been taken away, which is the capital gain taxes. I think it should be a relatively straightforward move towards getting euro clearability for Indian bonds. If that happens, I think one of the big issues around operational ease of investing in India, that goes away. And then yeah, I think it just becomes a lot more attractive.
What assumptions are you making about RBI moves from here?
So for now, we do think that RBI is on an extended hold. So we do not see RBI moving again.
For the rest of the year?
For the rest of the year and probably a good part of next year as well. yes, there have been some concerns around inflation, but RBI has made it amply clear that they are willing to see through it. They do see it as more supply side driven, and monetary policy clearly, as we know, is not the best instrument to handle supply side disruptions in inflation. So, and now that some of those concerns have already receded to an extent, we do think that RBI stays on an extended hold.
Do you see further measures and incentives from either the government or the RBI to boost Indian bonds further?
I think we have seen at least the bulk of the measures already. There is a window for over the next 3 months where some of these measures will be put in practice. So I think the path of least resistance is that RBI will wait and watch and see, and including the other Indian authority, they'll wait and watch, see how these measures play out. And if need be, we might see some more measures. But for now, we are not holding our breath.
The biggest risk that you see?
Potential political instability. If that happens, again, that's
arising from relations with the U.S.?
Could be. So broader geopolitics, even local politics. Again, it is a coalition government at the center right now, so it is not the same single party majority that we have seen earlier the last 10 years. So while it is not in our base case, but at least something that we keep an eye out for. If we get some concerns on that front, then again, the whole broader fiscal consolidation comes into question. So that's something that will always keep monitoring.
Prashant, thank you for your thoughts today. Prashant Singh, MD and Senior Portfolio Manager for Emerging Markets at Neuberger. Of course, India starts trading in about 5 minutes from here. Let's take a look at how it is set for the open, coming off online in just a few minutes as the rest of the region paired earlier tech-led gains. Indian equities, meanwhile, advanced for a 4th straight week last Friday, marking the longest stretch of gains in over 8 months. The Sensex pointing to a higher open, up about 0.2%. Still to come, more on the outlook for energy markets amid fears of a global glut. Kpler senior crude oil analyst Muyu will be joining us with her insights. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Let's do a check on oil prices. They're fluctuating within a narrow range as we track the flows out of the Strait of Hormuz, and OPEC Plus signaling higher supplies. We know Brent crude collapsed by 30% in the second quarter as Washington and Tehran agreed to an interim peace deal, clearing pretty much the way for a brisk resumption of traffic via the Strait of Hormuz. Currently, we have Brent trading down by 0.4%. Let's get perspective from Muyu Xu, Senior Crude Oil Analyst at Kpler. Muyu, good to have you with us. What are you making of oil at $72 a barrel? Is this about fundamentals?
I think at this very moment, I think it is pretty much about the fundamentals, because the market is increasingly worried about oversupply as the Strait of Hormuz flows continue to increase, especially the backlog in the Persian Gulf has pretty much got cleared. Before the MOU was signed, there were still like more than 60 million barrels of crude that were loaded in late February or early March that were positioned inside that they can't get out. But right now, our data shows there were only less than 20 million barrels, and that the backlog clearance plus the new loadings have significantly increased the supply from the Middle East, and that's why we're seeing the increase in prompt supplies in the swap market, and that crushed the Dubai structure and also drive down the crude differentials, and that oversupplies also spill over to other regions like the west of Suez that push down the Dated Brent and also the crude differentials from, let's say, Latin America and West Africa.
Muyu, you say it is about fundamentals. Is there a sense that perhaps speculators are unwinding the geopolitical trade too aggressively? Because after all, when you take a look at the situation in the Strait of Hormuz or even the Red Sea, things are not that settled yet.
Yeah, indeed. But I find the oil producers that they have been finding new way trying to send out their cargoes, no matter whether there's back and forth and the rhetoric or there's renewed strike from the U.S. or from the Iranian side. If we look at the vessels crossing through the strait, we saw at least 40% of those vessels turn off their AIS and they were exploring new routes. And also the producers and also the majors or the key trading house, they were using the shuttle ferries to move out their cargoes. So there's just like a lot of new ways trying to maintain the market supplies.
So we're looking at new ways. I'm just wondering whether there's a new floor for Brent, given that, the Strait of Hormuz is easing. And also, we have OPEC Plus now boosting its production.
So right now we are looking at data Brent at low 70s, and indeed that the geopolitical risk premium will continue to offer some support, but the real oil flows in the market, unfortunately, they are the real barrels, and they went down on the oil prices, and that OPEC Plus over the past few months, those unwinding, they're more like theoretical, they're paper barrels, but with the Strait of Hormuz continues allowing, the vessels going past either with or without their ASS on, they become the real barrels in the market. So this unwinding will translate to the real growth in the production.
The narrative in the oil market has quickly turned from a shortage to a glut. What assumptions are you making about demand?
Demand is also recovering because right now there is a lag between the recovering from the crude oil supply and the product supply. So that means like the refining margins is still very strong. The product crack is still very healthy. So that encouraged refineries to maximize their production. But some countries, let's say India, they're still about 300 kbd lower compared to their pre-war level. South Korea about 200 kbd, and more importantly in China is about 2.5 or even 3 million barrels per day lower compared to their pre-war level. So the demand side is recovering, but the pace might be slower compared to the recovery from the supply side. That's why there is concerns about oversupply, at least like in the near term.
Right. And when it comes to demand, a lot is contingent on Chinese demand. It has stepped back from buying crude for quite a while now. How are you assessing Chinese demand for oil?
If we look at the fuel consumption, this will just accelerate the energy transitions, and more people they're opting to buy the EVs rather than fossil fuel cars. And then at the same time, the prices also play a part. So some of the demand will gradually come back. Here we're probably talking about 50% or more than 50% can come back. Maybe not immediately, but in the next few months. But some demand probably will permanently lost. But then another part of this picture is the Beijing's policy on the refined product export restrictions, because Beijing still have their energy security concerns. So unless Beijing relax that restrictions, I don't think the refineries will have strong motivations to significantly increase their crude buying and also crude runs. So that's why, like in the short term, we don't think that China's buying demand will come back in the large scale.
And Muyu, how about India's demand? This could be a longer-term take on India's demand, because as a result of the disruption in the Strait of Hormuz, India is now looking at refineries in Rajasthan. How might that shape India's own needs for oil?
I think India's oil demand will continue to rise. There are a few new projects that are going to come online. With oil prices come down, the margins recovers. Some of those projects might come online like on schedule or even earlier than scheduled, but it really depends on the situation. I think another thing is the crude sources. I think quite a good example is if we look at the June arrivals, India's import of Russian crude hit a record high of 2.5 million barrels per day. And that trend may continue because right now there's just like so many oil in the market, and India has a lot of choices. They can just go with the cheapest they can, and that will just help the refiners to maximize. Overall, is in a good position.
Muyu, I want to touch on OPEC Plus. It continues to ramp up its production. Do you see OPEC Plus continuing to do the same in the coming quarters?
Personally, I think so, because even though right now there are just like too many oil, and some people start to think, is it time for OPEC to introduce another round of voluntary cuts? But because of the Strait of Hormuz closure, many producers in the Persian Gulf, they weren't able to sell their crude to the international market. They weren't able to capture any or like as much as oil revenue as they wish to. So it is very difficult for OPEC to introduce the cut at this moment. Maybe the near-term policy is to allow the producers to maximize their production. Forget about the compensation plan, just produce as much as you can and to make up your losses. But as the market stabilize, let's say like the US-Iran peace deal can stay, then maybe later in the Q4 or in early next year, it is time to rethink about the OPEC policy, because at that time, I mean, the UAE and also non-OPEC Plus, they will continue to increase their output, but the demand probably already come back to the pre-war level. We will be seeing about 2 or 3 million barrels per day of oversupply. Whether the OPEC want to manage the supply as they previously did, that would be a question. But probably that concern won't happen in the next 1 or 2 months.
Very quickly, Muyu, are you concerned about the discord within OPEC Plus? Iraq, for instance, wants to produce even more oil.
I think they want to, but the question is whether they can produce that much, and whether they can send their oil to the international market. At this moment, yes, the government already gave out a lot of ambitious number, but the main constraint is still like whether there are enough vessels coming to pick up the oil.
Muyu, thank you. Muyu Xu, Senior Crude Oil Analyst at Kpler. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.